and welcome to another episode of the Kinvestor Report, where I, Arlen Hansen, chat with industry experts to discuss the market, commodities, stocks, of the economy. I'm your host, Arlen Hansen. This interview is not investment advice, not investment advisor or professional geologist. However, I have been investing in small caps and kicking rocks for over 24 years. If Kin or myself has any financial interest in any company mentioned in today's interview, it will certainly be disclosed, but do your own due diligence, of course. Today, we're joined again once by Adrian Day, Chairman and CEO of Adrian Day Asset Management, widely recognized for his deep expertise in resource investing, particularly in gold, silver, and he brings decades of experience navigating the long cycles, volatility, and opportunities in this space. In our last conversation, Adrian shared valuable insights on investor psychology, critical role of gold in preserving purchasing power, and the unique value position of royalty companies. Today, we'll be taking that discussion further, looking at where we are in the current gold cycle, the outlook for silver, portfolio positioning, and what investors should be paying attention to as the market evolves. Well, Adrian, thanks so much for joining us again. Last time you emphasized that gold cycles are longer than economic cycles. So where do you think we are right now in the current gold cycle? We just said a year ago you were on the show and it was like the worst of the worst. So what signals are you watching now with where we are?
Well, first of all, thank you for asking me back, Alden. I'm not sure it was the worst of the worst. We were all frustrated, but gold investors, just as a sort of tangent, gold investors always seem to be disappointed. It's never good enough. Last November, gold was up, if you remember, and even the gold stocks was sort of, moving up. But anyway, where are we? Well, this has been, I'm not going to use those four most dangerous words. This time is different. But the reality is that the gold market this time has actually been different from certainly the last several cycles that I know of. I don't mean from history, but going back to, really going back to the early 1970s, this has been different in the sense that, gold moved significantly before the gold stocks even started to move. We all know why that is. The people buying gold, like the central banks and Chinese non-official, as well as wealthy families concerned about, the fiscal situation in the US and around the world, were not buying for investment gains. They weren't speculating. They were buying for defensive and insurance reasons. And so if that's your motive, then you buy gold, you don't buy gold stocks. And so to answer the question, where are we? In terms of gold, we're probably, I'll use a cricket analogy, probably the fifth and sixth batsmen are out, and there's 11 batsmen, just to give you an idea.
Thank you for all us non-cricket players.
But in terms of the gold stocks, frankly, I think we still have, if not number one and two, the opening batsmen, we still have, let's say, 2 and 3. And the reason I say that is because North American investors generally, ordinary investors generally, I won't say retail because that sounds almost condescending. I'm not quite sure why, but it seems to. but ordinary, and what I'll call ordinary investors that are not highly sophisticated, but are not doing this day in and day out, and that are not gold specialists, they have barely started to turn towards gold. And you can see that very, very clearly in the gold flows, in the flows into GDX and GDXJ. I mean, if you or I, or a small family office that's bought gold in the past and has a small staff that can investigate, we will probably buy individual stocks. But if you're the dentist in Oklahoma and you call your RIA, who your registered investment advisor or your financial planner who's on the Schwab platform, he knows nothing about gold, and you know nothing about gold, except you want to buy a little. Shouldn't we have a little gold? Well, what does he do? He doesn't buy triple flag. He doesn't buy Picoy. He buys the GDX.
Yeah.
And so the flows into GDX are a pretty good indication of what ordinary investors are doing. We've only just started to see a turn in those flows. You know, I just got some numbers. Up until the third week of August, it was pretty much relentless outflows all year. $3.5 billion of outflows all year. Since the third week of August, so let's say over the last month, that shifted. But we've still got over 300 million of outflows in the last month. Now, I mean, just think about that. Look at what gold is doing. Look at what the gold stocks are doing. Look at the fact that all these people are not only underweight, but for the most part have zero gold exposure. And yet we are still getting outflows from the GDX. That to me is mind-boggling. But we have seen a bit of a turn. If you look at the last month, we've had several days of inflows. So it's shifting. And I know, just to close on this, I know from my experience with the fund, I manage Peter Schiff's Gold Fund. I'm not sure I'm allowed to give numbers, but I think I'm allowed to say that over the last sort of month, we've had steady and reasonably healthy inflows for the first time this year. So I think things are shifting, but they're shifting very, very slowly. And that's why I say, you know, we're really in the early innings.
Is there somewhere where the average retail investor, not to be condescending, can find where those inflows and outflows go from these
Well,
GDX?
that's my secret.
Okay.
Because no, I'm joking. Because most people I talk to, even people in the investment business, say, "Oh, how do you find that out, Adrian?" Yeah, there's this. If you just type in on the Google search, just type in GDX Flows, and it's a website called. Give me a second. It's a website called VettaFi, VETTA. FI, Beta Fi, and they have the flows on a whole bunch of funds.
Okay. There you go. We can end the interview now. We just gave all our audience some excellent information.
I know. Now I'm not a step ahead, you know. When I was a teacher for a while, and when I started, I was a substitute teacher, and they'd often say, "Oh, you know, you're teaching chemistry tomorrow." I said, "Chemistry? I know nothing about chemistry." But you know what? You read a chapter in the textbook and you're one step ahead of the students.
Yeah.
Now I'm not a step ahead of everyone.
So we talked about earlier, I said, oh, the worst of the worst last year, and you're like, no, it wasn't. But I look at some of the names that you had kind of you picked on, like Franco-Nevada in the royalty sector, like Franco-Nevada, Wheaton, Origin, Metallic, they've all doubled, right?
Yeah.
And then the bigger names like the Agnico, Barrick, Newmont, B2, they all doubled. Basically, all of them are basically doubled since November of last year.
Yeah.
How do we go and find stocks that are like, how do we find stocks that are cheap again? Like
Good question.
where does this go, right? Like, yeah, like we're long and I've learned to stay long trades that are working, right? As long as until they stop working. But like, where do we get leverage again? Like, where do we find some of those cheap names, good quality names, do you think?
No, that's a really excellent question. And let's discuss that because there's several aspects to that. First of all, as you mentioned in the introduction, I think you did, or was it before we talked? I can't, before we hit record, I can't remember, but you know, gold cycles tend to be long. And you look at 1970 to 1980, you look at 2001 to 2011. These are long cycles. And I think so first of all, I'll say you're so right to stick with good quality that's working, you know, until it gets stupidly priced. And we're nowhere near stupidly priced yet. And I think one of the mistakes that a lot of people who've been in the gold, who, you know, have had gold stocks for a while, particularly if they've been in the junior sector, you know, they've seen so many false starts. 2016, remember we had a bit of a rally, 2018.
Oh, 2019, or sorry, 2020 too. Like,
yeah, and every time it collapsed. And so the danger is that those people who've been in the sector the longest are the ones who get out earliest. And so the first thing I would say is, remember, gold cycles are long. Look back at, now, price is not everything, of course. Oscar Wilde famously referred to people who know the price of everything and the value of nothing. But just looking at price, look at Barrick, look at, you mentioned Metalla, look at Metalla, look at B2, you mentioned B2, I've forgotten which other ones you mentioned, but look at those stocks. They are still selling significantly below their highs of the last 10 years, significantly below. Maybe in Barrick's case, high of the last 15 years, but significantly below. So that's the first thing to set the stage. You know, this is going to be a long cycle, I believe. We've got a long way further to go. The second thing I'd point out is that the valuations are still very, very reasonable, even on these stocks that have doubled. So we forget, you know, we look at price. It's easy to do, you know, because price is the most obvious thing. Agnico's gone from $35 to $160 over the last, I don't have it in front of me, but whatever it is, over the last 4 years. And it's more than doubled this year. And your immediate reaction is to say, must be expensive. But let's not forget that when the price of gold goes from 1,200 to 3,700, what happens to the value of reserves in the ground? Not only do they go up triple, right, because the price of gold tripled, but they go up more than triple because more of your resources now become economic at a higher price. So you have leverage on the price of gold to your reserves and resources in the ground. Your mines, of course, are far more valuable. And again, you can produce more. You know, people are expanding their pits because that part of a pit used to be uneconomic, but at today's price it's not. So you expand the pit. So you have leverage on that. The margins have just gone absolutely ballistic. I don't know how much longer that will stay, but the price of oil, which is the largest input of mining, has hardly budged in the last 5 years. Yeah, remember it was in 2011 at the last peak, oil was selling over $140 a barrel. And so from 2009 to 2011, even though the price of gold moved up, you had no margin expansion at all, because the price of oil went up and because what we call the commodity currencies, like the Australian dollar, the Canadian dollar, the South African rand, those currencies which are which are a proxy for your second largest cost input, because that's all of your local costs, right? Costs of labor, costs of food, costs of camping and everything. All of your local costs are denominated in the currency in which you have the mine. Well, look at that. The Canadian dollar, what, 1.37? So inverse that. So it's about 80, whatever it is. I always think of 1.37, but it's selling at a significant discount to the dollar. 2011, it was selling at a premium to the dollar. Same with the Australian dollar. So anyway, the point is that the costs have hardly budged, and they're much lower than they were back in 2011, despite the inflation we've seen. So the margins are just astonishing. That means your cash flows are incredible. So as the price of gold goes up, your cash flows have increased tremendously. And again, leveraged to the increase in gold, your margins have gone up by a factor greater than the increase in the price of gold. And so what happens to the valuations on the stock? Well, your price to NAV doesn't move as much as the price of a stock. Your price to cash flow doesn't move as much as the price of a stock. And so if you look at the valuation metrics, the big cap stocks are actually barely more expensive than they were a year ago. You look at Agnico, I mentioned Agnico, and I mentioned Agnico because it's one of the big three but there's nothing wrong with it. You know, when you say the barrack's cheap, people say, oh, that's because of Mali and Pakistan. Well, there's nothing you can point to with Agnico and say, oh, it's cheap because, you know, it's a great company with great mines, great pipeline, great jurisdictions, great balance sheet, great management, et cetera, et cetera, et cetera. You look at the price to cash flow today, it is higher than last year, but it is lower than every other year in the last 5 years.
Jesus.
So,
really?
Yeah, literally lower today than every other year in the last 5 years, other than last year. So the stocks are not expensive at all. So this is a very, very long answer to your question. Where do we find value? I would say for investors who are not already in this sector, you find value in some of the best companies out there, like Agnico, like Franco. Imagine what happens when Cobre Panama comes back on. That
Yeah.
used 20% of their revenue. You know, even without Cobre Panama, they're going to double their revenue in the next 5 years. But with Cobre Panama, that's going to be a huge boost to the stock. So I would say the first thing is, and look at Metalla. You mentioned Metalla. Look at Metalla. That's trading, even after this big move, is trading probably at only, I'm estimating 0.8 times NAV. That's very, very reasonable for a company that's growing like that, with new royalties either coming on stream in the next 2 years or new royalties ramping up significantly in the last 2 years. Like they've got a royalty on the Gosselin, which is adjacent to Côté. You know, IAMGOLD's big mine in Toronto. They've got a royalty on Copper World, and then some of the further dated ones like Taka Taka and Nuevo Union. And so growth, they have tremendous growth, and yet they're selling at 0.8. And we could go through a lot of companies and do the same sort of exercise. So first of all, I'd say the highest quality companies are only expensive if the gold price turns and drops. Then to answer your question, where do we find value? I think I've done this myself. I did this when I was new to the business. You look and you say, oh my gosh, B2's, you know, gone up 50, doubled. Agnico's doubled, Franco's doubled. Why don't I buy Moose Pasture Incorporated? Because it hasn't moved yet. Big mistake, because there is probably a very good reason
why it hasn't moved yet. Yeah.
So as a general principle, I would much rather pay up for quality than pay fair value for garbage.
Yeah, well, I think when you get these quality companies too, as well, you get some excellent operators, right? And when you get excellent operators, they know how to take advantage of higher gold prices when it comes to operating the mine.
Yeah.
Right, like you talked about it earlier, right? Can we take a new
Yeah.
pit over here that wasn't economical, blend it with our higher grade and extend our mine life, right? There's all sorts of things a good quality management team can do to increase the cash flow in times like this. And you're only going to find those people in good companies.
Well said. And the reverse is also true. The person has been seriously successful, like Ross Beatty. He may have some hiccups, but you know, if you bet on Ross Beatty, you're probably not going to go wrong. And yet the guy that's been in the business for 40 years and has never had a success, why should we think he's going to have a success next time? Now, I will say, to answer your question, because people want to know this, other than, you know, when you're looking at, well, where can we find value? I think you have to be really, really alert and really, really watching this day in and day out. And I'll give you 2 examples. I think I can say this without violating SEC rules, because they're just things in the last 2 weeks and we don't know how they're going to work out, right? So
Perfect.
I'm not cherry picking winners.
Okay.
These are, I'm naming these 2 as examples of where you can, I'll say 3. So one is a company that you like, but is overvalued, is expensive, and you wait for that opportunity. The example I would have there would be Orla. You know,
Or
Orla Orla, ORLA. Orla has, it's not very well known. Orla has or it's not as well known as it should be because it's a relatively new company. They have 3 mines. They have an open pit silver mine in Mexico. They bought Musselwhite from Newmont when Newmont sold it off. And they also have a South Railroad project in Nevada that is not yet in production. So the Mexico and the Ontario are in production, and then the third one. Anyway, the story is they're expanding the pit in Mexico. People tell me outside of the company, people in Mexico tell me that there's no reason to think they won't get the permit because it's simply it's ORLA in US, and I think it's ORL in
I'm looking at it right here.
And so anyway, all a good company, good people, good management, good minds, growth ahead of them, and yet just really expensive. And what happened? Well, first of all, Agnico, which had a large position in the company, decided to sell their stock. And then last Thursday or Friday, I forget now, Newmont decided to sell their stock in a secondary offering. So that was in the market. It wasn't an arranged cross. It was in the market, and the stock dropped, as you can see on the chart. It dropped about 15% in one day. That's an opportunity. If you've been watching the company, if you like the company, that's an opportunity. Now, I'll say one thing. You have to like the company, right? You can't just say, oh, it's dropped 15%, let me buy it.
Yeah. You should still know the DNA of the company.
Right. A second, I think perhaps, so that's one example. A second example would be Equinox, which had, lots of problems. The new mine, Greenstone, was not operating as well as it should have been. They kept missing, they missed their guidance and their projections several times. The ramp up seemed to be going slowly. And because of that, they also had to do more equity than they said, frequently, more than once. They said, we're not doing any more equity, but had to do more equity, took on debt. So you had a situation where their flagship mine was ramping up slower than expected, and they had a bad balance sheet, right? They got a new CEO and a new COO, both highly respected, and you can see what's happened to the stock in the last couple of months.
Well, they just took over. Yeah, they took over.
Calibre.
Calibre.
Yeah, and they got the CEO from Calibre.
Yeah, Darren Hall.
Yeah.
Yeah.
Great reputation. He's got a superb reputation. It appears that they're turning around Greenstone, and with the turnaround of Greenstone, plus the start of the new mine in Newfoundland, Valentine Mine, which
that looks like a rocket ship.
Yeah, not only do they have more cash flow, but are able to repair their balance sheet. And so look for a stock that has good assets. You like the company, good assets, but it's been, I hate to say failure. It's had significant problems, and that's why the stock has lagged. Look for a trigger to turn it around. We could almost say the same about B2 Gold in a different way. Now the Goose Bay, which was over budget and over time, long story there, not necessarily B2's fault, but nonetheless, now that mine seems to be operating, the Goose Bay seems to be operating well. That's a company that can now reverse course and get back to a normal valuation for the company. So that would be a second one. And then the third one I would look at would be new companies coming to market, because sometimes smart people, and I'm thinking here, Pecoy is a copper company, Pecoy Copper, which is Vince Metcalf and Joseph de la Platte. They're the people you probably know. You should know the names if you don't. They were the team at a Cisco years ago that generated, was in charge of generating the royalties. They left and started Nomad.
Hmm.
Nomad was subsequently sold to Sandstorm. And now they're starting two new companies. One is this Pecoy Copper. Smart people, when they take their stock to market, they do not try to squeeze the last possible cent out of their offering price, which is counterintuitive because you're thinking when you go public, you want to raise as much money as you can for as little dilution as you can. No, on the contrary, they want to have the stock at a good price so that new people will come in and buy the stock, provide liquidity, and provide a gain for the stock. So if you look at a company like Pecoy, it's very thinly traded. No, it's not thinly traded. My gosh, it's done one.
What's the symbol on that?
Well, I don't want to tell you because I haven't
Oh.
finished.
Well, there is Google. There is Google. I'm sure I can
It's
Google.
PCU on Toronto. I see it's just on 1.2 million shares already today. So it's not thinly traded. Now they're going to come out with another, they have two companies, as I mentioned. The other one is a royalty company called Evolve.
Yeah.
They're an RTO with Voyager. Voyager's halted. You can't do anything with this at the moment. But when that's listed and starts trading, that would certainly be one to look at to say, okay, did they do the same thing that they did with Pecoy? Is this a reasonable valuation that I can buy? Another one coming up, I don't know the timing on this, Voyager or Evolve, it'll be called Evolve, but it's RTOing with a company called Voyager, should be trading within a month. The other one I'm thinking of is Summit Royalty. Drew Clark, who was the
Is he
business.
is he behind that innovation mining as well?
Sorry?
Is he behind that innovation mining as well, Drew Clark?
No, I don't think so.
Yeah, okay.
He was a Metalla.
Yeah.
He was the business development officer of Metalla. He left, but his intention is, at least he said, he's going to bring the company out at a reasonable valuation so that.
I love that. Like bring it to the market to give everybody a shot to make money. Because
Yeah,
when you do that and you get people to make a shot to make money and they do make money, that's how you create loyal shareholders too,
of
as well,
course.
right? Like trying to squeeze every penny out of your investors and then day one they're down 10, 15%. What a perfect way to abandon your shareholder base. It's like, I want
Absolutely.
everything for me. Screw all you guys. No,
I
this
know.
is
And
not how we play the game. That's
the
not how,
insiders who got in really early,
yeah.
they see it come out at this ridiculous valuation and say, gosh, let's take our profits now while we can.
Yeah.
Yeah, absolutely. So anyway, those are sort of three things to look at. The laggard that's lagged for a problem, but is a turnaround. The great company that's doing well, but is overpriced, but falls for some reason. And then new stocks that are not overvalued.
Awesome. Well, I'll take those, look at them for sure. I just want to touch base on one thing before we sign off. I want to talk about this investor amnesia. Because like that's actually something we talked about a lot last year, to be quite honest. And I want to bring it up again because as you were talking about these higher price stocks, I'm going, man, these stocks have all doubled. Like I myself am going, oh, they've doubled. And I just looked at the venture board and I forgot that it was 3,000. It's still only trading at 900 after these stocks have doubled, tripled. I'm involved with I've made some investments that have been 10 exits this year, right? And like lucky discoveries, right? Like, great. I'm not smart. I just got lucky, you know. Um, but yeah, you forget the leverage. It's been so long since we've had such a good market. I've even forgotten how good and how high these stocks can go.
And it's only just beginning. I mean,
Eh,
you mentioned the juniors, if you look at that index, last time I looked, which is admittedly 2 weeks ago, it was up something like 6% over the last 2 years. I mean, sort of nothing.
mhm.
And all of that gain was from a small minority that had had success and doubled or tripled. The mass of the stocks, even good quality stocks, have hardly moved of the
Yeah,
juniors.
yeah, yeah. Oh man, I got goosebumps. I got goosebumps about getting excited about what we're gonna see in the next few years, and just stay cool, calm, and collective, right? Just
Yeah.
so this is what we got to do, right? We can't panic at the bottom. We can't be all cool at the top and buy champagne at the top. We just got to stay calm and collected through it all.
I would also say it's probably a good idea to keep some money in reserve. There will be a correction at some point.
Yes, there will be.
Yeah. And with certainty, there will be individual stocks that have corrections for one reason or another. It might be a horrible incident like a mining accident that, kills people. We've just got that horrible mine in accident in Colombia, but people are still alive, but they're stuck underground. But there'll also be other things. Like I mentioned, Newmont wants to sell their block in a company and they do it at a discount. There'll be situations where individual stocks come back, but there'll probably be a pullback in the whole market at some point.
And not that my audience cares what I have to say about this, but I have found those short-term tops in a bull market always wrapped around when these bought deal financings are being done, and then they get oversubscribed, and then they get oversubscribed again, and then they close. And you see a flurry of those over a period of 3 to 6 weeks. And it
Yeah,
always, to me, has marked a short-term top.
absolutely. One of the reasons it marks a short-term top, of course, is because the companies raise so much money from gold investors that the gold investor segment has no money left.
Totally. That's exactly what it is. No one left to buy the stocks afterwards
Yeah,
because they're tapping
yeah,
into the same pool of capital, right?
of
And it's a
course.
very
And the only,
it's a very
yeah,
finite pool of capital, right?
right. And
Us
the only
crazy,
way
us
you can
crazies.
buy something is to sell something else.
Totally, totally.
Yeah.
Oh man, Adrian, I love chatting with you. You're like, I love what you have to say, what you bring to our audience. So
Well,
yeah,
thank you.
thank you so much for your time today. Super insightful. Really excited, and we certainly will bring you back on again just to check in on some of these names and where we are in the cycle.
No, I'd love to, and thank you. And do you mind if I just tell you my website?
Oh, of course. No, we'd put it up anyways, but please do.
Oh, you put it up anyway.
Oh
Okay,
yeah,
it's
yeah.
adrianday.com. That's
Yes, we'll get it up there.
okay.
And yeah, please follow him. And yeah, he's an excellent money manager and a great stock picker. So thanks, Adrian, for your time.
Well, thank you very much. I really appreciate it.